Hey guys, what's up, how's it going? My name is Rob and welcome back once again inside today's video. And inside today's video, I'm going to be showing you guys the easiest way to take $1,000 and invest it inside the Canadian market. Now, when it comes to investing, I know a lot of people get intimidated by the idea of the stock market, and maybe $1,000 feels like not that much money. In reality, it really isn't when you think about, long-term investing, but that's okay because you only need a little bit of cash to get started. Even with just like $100, you could theoretically, and you should get started with investing and just kind of do whatever works for you guys. So inside this video, we're really going to focus on the beginner aspect of investing. I'm going to explain to you guys and show you guys what to look for and kind of give you guys an example. Like if I was to start over and I had $1,000 to buy into the market, this is kind of what I would do. And when I first started investing, it was really just me putting small little chunks of money into the market and seeing the portfolio slowly grow over time. And then as my income increased and as I better understood investing and I learned how to budget, you guys can see here that I just kept putting more and more money inside the portfolio, and that money just started compounding and growing on its own. And in this channel and inside this video, we're actually going to be focused on the fundamentals and act as if we are complete beginners into the market. So if you are a beginner dividend investor and you want to get started, then this video is definitely for you. And the main focus for this video will actually be focusing on individual stocks to add inside your portfolio. I will touch up upon ETFs and whatnot kind of towards the end of the video really briefly. But in the beginning, inside most of this video, we're actually going to be focused on buying individual stocks. And there's nothing wrong with buying individual stocks inside your portfolio as long as you're buying good quality dividend-based stocks. So if you guys are enjoying this video so far, please sure to give it a big thumbs up and do me a favor and subscribe to the channel if you guys want to get more Canadian-based dividend investing content. And I really want to mention really quickly here, guys, before we get inside the video and we talk about all these different things that you want to look for, that everybody is going to build their dividend portfolio just a little bit different depending on what type of investor you are and depending on what your goals are and where you are in your life. Some people might be more focused on dividend growth because they want to get more growth over time, or maybe they have, a job or whatnot and they have a lot of income, so they don't really need the dividend income right now, but maybe they would like it in the future, or maybe you're older and you want that dividend income right now. So depending on your needs and where you are and what your goals are, I kind of advise you guys to do what works for you, kind of take this information and adjust it based upon the type of portfolio that you want to build. And don't be afraid to take things slow and kind of try things out and just kind of slow yourself down as you're kind of trying to figure out what type of investment portfolio that you want to build. Alright, so let's get into the video and let's focus on what type of things we are looking for when it comes to dividend stocks as a dividend-based investor. So for starters, one thing I want to point out really quickly is that dividend stocks, generally speaking, are thought as to be long-term investments. These are investments that you're going to invest into, and over a long period of time, you can just see them grow as time goes on, and those dividends will get reinvested. And as the stock price of these stocks grow as well, your money will increase in two different ways. So that's the value of dividend investing, and I really want you guys to think about dividend investing as really long-term investing and not like making a quick buck, but slowly on a regular basis making money and watching your portfolio grow over a long period of time. Now, the next step as a dividend investor is to look for companies that have a good solid dividend yield, or companies that are growing their dividend yield. So here we have Algonquin Power and Utilities, which is a nice Canadian company that I hold inside my portfolio. And if we scroll down here, we can see that they currently have a dividend yield about 4%. Generally speaking, we want to look for stocks to have a dividend yield around 2 to 4% if you want to pick up a stock that's already generating income. The exception to this rule is basically if you're looking for a stock that's growing its dividend or aggressively growing its dividend yield, it's okay to have a stock that's a little bit lower than that, but you generally want to kind of have one that's in this range, especially if you want to be hitting like passive income on a regular basis right now. And you'll see that some stocks are a little bit higher than this, they're a little bit lower, but ultimately it's up to you. But I like to shoot for that 2 to 4% range with the stocks that I buy inside my dividend based portfolio. And the third point I want to just kind of touch up upon really quickly here, and this goes in line with what I mentioned earlier about a stock growing over time, but you want to see stock appreciation on a regular basis. This is RBC, the ticker is RY, and here's a peek at their past couple years growth rate. So we can see in the past year, RBC has grown 41% in the last year or so. Over the past 3 years, the stock has grown 17%. So kind of like think about getting 17% over the course of 3 years averaged out. And over the past 5 years, RBC is up 54%. So that's almost close to 10% gain per year. So you want to look at stocks that not only have good dividend yields, but also stocks that are growing in stock appreciation over time. And this is something that a lot of dividend investors really neglect and they miss out on. And the last very important point you want to look at as a dividend investor is the dividend growth rate of a company, not to be confused with the dividend yield. The dividend yield is basically the current dividend yield that the stock is currently paying out. The dividend growth rate is kind of how the company is growing their dividend on an annual basis. Here's Enbridge stock, a really popular Canadian stock. You can see over the 26-year period, their dividend growth rate is about 10% averaged out per year. So basically, imagine every single year your dividend, the actual amount of money that you're getting in paid dividends, increases by 10% per year. That's a huge increase. So when you're looking for companies, you want to look for companies that also are increasing their dividend growth rate, so those dividends that you're getting on a regular basis keep increasing over time. Alright guys, so that's some basic analysis of what you want to look for inside dividend stocks, and I know it's really basic and there's lots of other things you can do, but as a beginner, I really like to just focus on these simple things because it's important to kind of just look at the stocks, look at the history, and just see, in the past how these stocks have done and kind of apply that to see, it gives you a good idea on how they're going to perform in the future. So now in today's part of the video, I'm going to take 3 stocks that I normally don't talk about in this channel, and we're going to analyze them, and I'm going to show you guys what I would look for if I was interested in buying these stocks. And then towards the end of the video, I'm actually going to buy one of these stocks. I'm going to buy the stock that I think is the most attractive looking. So let's dive into these stocks and let's take a peek and let's analyze 3 Canadian stocks that we want to add inside our portfolio. All right, guys, so the first stock we're going to look at is a stock that I haven't really talked about on this channel, but I've been kind of watching for the last little while, and I hope I'm pronouncing this correctly, but it's Alimentation Couche-Tard. So this is the company that actually owns a lot of those convenience stores we see. They are called Circle K's, the Max convenience stores. You can see this little bird icon here, but it's basically like a convenience store type company, and they've been doing really well for the past while. So when looking at a company like this, the first thing I always like to look at, like I mentioned before, is this company been growing over the past whatever period of time? And we can see here with in Google Finance, we can see that we have a lot of data here. So we have about 20 years worth of data. We can see over the past 20 years, this company has actually grown quite a bit. So initially kind of just taking a peek at this and seeing this, over the past 10 years, this has been a lot of growth for this company. So far, this looks really good. And that's one thing I always like to look at, like, is the company growing on a regular basis? I really think this is super important. And the dividend yield of the company is 0.88%, so it's a little bit on the lower side. And this kind of fits into those companies that are kind of aggressively growing their dividends. We've seen them kind of in 2015. I'd say about 2012, they really started to hit some growth. So I think that's, and we'll take a peek at the dividend increases as we go, but we can see that this is a company that's more focused on growth, but in the process they're also aggressively growing their dividend as well. So this is kind of a cool company, and I think this company has a lot of potential going into the future. And to take this one step further and to put some numbers to this, we can take a peek at the yearly growth over the past couple years. So this is Simple Wall Street, another cool website. Over the past year, we can see this company has grown by 17% in 1 year, which is pretty good. Over the past 3 years, it's grown 45%, which is really, really good. And over the past 5 years, we've seen it kind of a little bit less than that, but obviously the pandemic has really kind of pushed, I guess, the recent past couple years down quite a bit. But we can see here that this company's up 40% in the past 5 years, which is really good. And this cool little thing here is this is just stock appreciation, not even including the dividend. So if you check this little box here with the dividend growth, we can see that if we were like kind of investing in the company and reinvesting our dividends, we can see that 1 year growth rate all of a sudden turns to 18%, the 3 year growth rate turns to 47%, and the 5 year growth rate turns to 43%, which obviously pushes things up quite a bit, which is really cool. So this company, initially looking at the growth and whatnot, is a fastly growing company and doing very well, and I really like to see this in a company. And here's a quick cool little graph to show the dividend growth rate of this company as well. And if we average this out over the past since 2005, this company actually has grown their dividend on an average rate of 22% per year. So that's like really a lot. And you can see here that most of that growth obviously came over the past couple years, kind of around 2014, 2017. But here on the right side, we can see the cents in dividends. So we can see in 2010, they were paying a dividend around 6 cents, went up to about, I would say, 8 cents or so, and then just kept increasing from 2013, dividend of about 11 cents to 16 cents. And it doesn't seem like a lot, and it isn't a big dividend, but that percentage just gives you an idea of, imagine growing 22% per year. That's quite a bit. Like, so as you guys can see, as the dividend increases, that those dividend increases all of a sudden account for more. And obviously, as a company gets bigger, those dividend increases are going to be they're going to decrease to some degree. But I still think this company is in its growth phase and it's doing really well. So if you're looking at a company that is growing its dividend very good, this is a company that's definitely doing it. So overall, I think this company is a really cool company, and I think as a dividend investor, they're very attractive right now. The next stock we're going to talk about in today's video is going to be TC Energy. This is another pretty popular Canadian stock, more commonly one, and this one is a lot different than the Alimentation Couche-Tard Max convenience store stock that we talked about before. This one's a little bit more established, and it is a pipeline company that deals with natural gas, pipelines, and energy and whatnot. So this is one of those popular energy stocks. We have a lot of these in Canada, obviously. So TC is a company that obviously has been around for a long time. We can see this data goes all the way back to 1995 here on the graph. And like I said, it's a dividend stock. You want to see the stock growing over time. And we've seen this stock for the most part grow quite a bit. We've seen a little bit of dips here in the past little while, but every single time there's been a dip, there's been a good recovery, good recovery. And then we can see basically the last year's pandemic, it's still kind of recovering a little bit. But overall, it looks like this company is doing pretty well. Now, here's the interesting thing. If we look at the dividend yield of the company, it's actually 6%, which is much higher than the last stock we took a peek at. So this is a company that's already kind of hit its growth. It's already aggressively grown its dividend. It already has a well-established dividend yield. So if you invest in this company today, right now, the moment you invest in the company, you would be getting passive income. So if you're looking for income right now, this is more the stock that you want to be looking for, as opposed to Couche-Tard, which is more like a long-term growth stock that over time and going into the future is going to kind of slowly increase. I should say fastly increase their dividend yield, but it's not quite there yet. Now, this company actually has a dividend yield here right now, but let's take a peek and let's see if this company is still growing their dividend at a good basis. So here's a cool little graph to see the appreciation of TC Energy, and you guys can see there's once again pretty big differences here than the last stock we took a peek at. So stock appreciation for TC Energy over the past year is 2.8%. Not the greatest. Now obviously there's a lot going on, so I want you guys to consider that, but much less than the previous stock we just took a peek at. Over the past 3 years, the stock appreciation is 8.9, so once again a lot less, but that's a little bit better, but still not the greatest. Over the past 5 years, it's up 15%. So not a lot of stock appreciation with this company. They're actually struggling in that department. But once again, this is a dividend-based company. So let's turn on the dividend returns and let's see if we kind of reinvested that dividend income. Let's see how the return basically changes. So all of a sudden, we can see over the past year, we have a 9% return, which is not too shabby. Over the past 3 years, we have a 27% return, which is pretty decent actually. And then over the past 5 years, we have a return of 44%. So you can see the importance of, if number one, if you're buying dividend stocks, investing those dividends back into the company is super important. It's pretty much fundamental. But number two, you guys can see that, this company isn't so much in its growing phase, it's more in its dividend phase. It's already established that dividend, and that dividend is generating you income, and that's where the bulk of the returns is coming from. But going into the future, once again, it's important to see, is this company actually growing this dividend? Let's take a peek in the peek at the past, and let's see how, they've been growing their dividend over the past little while. So I pulled up this cool little graph from the TC Actual Energy website to show their dividend growth rate over the past, looks like the past 20 years or so. And over the past 20 years, since 2000, it looks like TC Energy on an average basis, this is what the CAGR stands for. It's basically saying the average increase per year on an annual basis is 7%. So that's not too bad. That's a pretty decent. I'd say that's kind of a little bit above average. It's not super high like we've seen the 22% from the previous stock, but 7% is still pretty decent. I want you guys to understand, for a company that's already has an established dividend yield, this is actually not too shabby. And we can see that recently they're still increasing that dividend growth. So overall, their dividend growth has been pretty solid. And it's interesting to take a peek at these two different companies, right? They're two completely different companies. So one's a company that's fastly growing in stock appreciation as well as dividend yield, that's going to set itself up for a good long-term growth. And then we have a company that's already established, has a little bit low stock appreciation, but already has a dividend yield that's paying out good returns, and they're still increasing that dividend yield. So two very different companies, and it's cool to see the contrasting difference. And the third company here is going to be a little bit different as well. So let's take a peek at the third company that we're going to analyze today. All right, guys, so the third company is going to be a company I haven't really talked about on this channel, and I wanted to focus on companies I don't talk about that much, and this is Pembina Pipeline. Now, this is another energy-based, pipeline-based company, and I'm sorry that I kind of picked two here, but I just wanted to showcase to you guys some different companies here. So this is Pembina Pipeline. They once again are established company. You can see this graph's been around since 2000, and they've been growing pretty well as a company up until 2015. Got a bit of a dip, a bit of a recovery going into 2019, and then the pandemic hit, and just like with kind of TC Energy was the case, they were getting back to recovering and growing, and then they took another big hit, and they haven't quite recovered that much since the pandemic. They got a little bit of growth, but not quite there. And once again, this is a company that already has a super high established dividend yield, about 7%. So you can see as a beginner investor, these companies obviously are pretty attractive to people because they already are established, they already have a good solid dividend yield. But again, I think portfolios kind of benefit from a little bit of both worlds, where you have all three, the three companies we talked about today. I think they're all good companies to hold inside a portfolio. So once again, let's kind of look at the stock appreciation and let's compare that to see what is the actual growth of the stock over the past couple years. Got the graph on Simple Wall Street, and here's the 1 year return from Pembina Pipeline is actually sitting at 25%. So they had a bit of a recovery, like I said, which is pretty good. Their 3-year growth rate is actually at negative 10%, which isn't the best, but they've obviously been struggling, and oil has obviously taken a pretty big hit. 5-year growth rate is at 6%, which is a little bit better, but still that's about 1% or so per year, which obviously isn't very attractive. But if we turn on those dividend returns and we reinvest those dividends, you can see that obviously it looks a lot better. So 1 year growth rate with that dividend increase is 34%, which is pretty nice. 3-year growth rate is 7% with the dividend reinvested, which is pretty good. And 5-year growth with the dividends reinvested is 40%, which is much better. And actually this company is, if you're willing to take on a little bit of risk and whatnot, this company might be an interesting buy, because we've seen them recover in the past and they had a really good year already. And if you've been investing since the pandemic, you might be sitting at a bit of a return depending on how much you had prior to that. But this is a company that it could do quite well in the future if you're willing to take on a little bit of risk. Might be worth investing into. But let's look at the dividend growth and let's see how well they've been at growing their dividends for that nice long-term growth. Now, sorry I couldn't find a nice fancy graph like I did with the other two ones, but a cool website if you can't find information, because some of these stocks it's hard to find the dividend growth rate actually documented, especially if it's like a smaller, less known company. You can go to Guru Focus. It's a nice little website here. Basically, so over the past year, Pembina's dividend increase is about a 7%. So they increased their dividend 7% last year. During the past 3 years, the average dividend per share growth rate was 7%. So once again, kind of following that 7% growth rate over the past 3 years. Over the past 5 years, once again, 7.2%. And during the past 10 years, their growth rate is about 5%. So 5 to 7%, 5% is pretty average, I would say, for a dividend stock, and 7% is not too shabby. So they're kind of not super aggressively growing their dividend compared to the other two companies that we talked about, but at the end of the day, they still are growing it, and they already have a well-established dividend right now, so they don't really need to as much. So once again, this is a company that's already established, already has a good dividend yield. It isn't growing it as much, but they've already had that income generated. So just an interesting way to look at, and just a kind of different type of dividend stock. So at the end of the day, you guys might ask me what stock out of these three would I actually go with, and I think they're all three of them are good stocks, and I think they're worth holding inside your portfolio. In fact, I do have them inside my portfolio, inside my main ETF. But if I was to buy an individual stock, I think the most attractive stock for my situation would be probably Couche-Tard. I think it's a stock that has a lot of growth potential, has a really good dividend growth, and is this company that is doing really well. Now, obviously, there's a little bit of risk and whatnot because it's still kind of growing. It doesn't quite have that dividend yield established yet, but I think this company still has lots of room for improvement. It's got very low payout ratios. They have a lot of earnings. I still think they have tons of growth. So I think this is a company that a lot of people don't talk about. Kind of might be a little bit underrated, but I think this, as a dividend investor, kind of investing into this now would definitely set you up for a nice, good long-term dividend stock with a lot of stock appreciation and a lot of dividend growth. So if I was to pick one, this is probably the stock that I would pick, although all three of them are pretty solid dividend-based stocks. As you guys can see, this is how we can very simply do some basic analysis of some stocks to see if they fit inside our dividend-based portfolio. Advice, if you had $1,000 to spare right now, would be to take that money and buy one of these stocks, or you could theoretically even take it and split it up into 3 different stocks, or you could buy an ETF and just keep things simple. So that's it for today's video, guys. I hope you guys enjoyed it. Please let me know what you guys think in the comments. If you guys have any questions, feel free to let me know. And once again, if you guys did enjoy the video, please sure to give it a big thumbs up. It really helps the channel out. Anyways, guys, that's it for today's video. I hope you guys enjoyed it. Take care, and I'll see you guys later.